So then, okay, so we've just started recording now. So that we can review this and then go back to this video later. Let me start sharing my screen, and then let's dive into the content here right away. Sorry, this is my very first attempt on this thing, so I'm gonna be a little glitchy here, but hopefully everyone can see the screen and nothing is coming and nothing is like distracting anything here. Anyway, a little bit of my background. Like I said, I've been trading for the last few years. The idea is to teach everyone how to do this thing successfully. We primarily trade short options. It's a very competent skill to learn, very complicated. It's not like buying stock and buying options and then just losing money on them, because buying these assets means you have a 50-50 chance of making money. Whereas when you sell these options, you have more than a 70% chance to make money. And I will show you everything on the platform. I will try to wrap this up in an hour so that we have enough time for questions at the end. And then so I can hopefully go through everyone's concerns, everyone's questions towards the end of this. Let's hop in. Let's go through all the modules that I've listed on the event page one by one. But keep in mind, options trading is difficult, and it's not like a lottery ticket. Well, buying option is like a lottery ticket because you have a very small probability of profit, whereas selling options gives you a different kind of wedge in the market. And I will show you my live P&L as well. You can see what I've done so far this year by just selling options on multiple futures and their options. Very important. We keep these 6 things in mind whenever we are trading. Always to trade, remember to trade small. We don't trade the whole account value ever. We only trade a small percentage of that account for each position. And then overall, we never put more than 50 to 60% of our account value at risk on our portfolio. So we just don't do that because we leave some dry powder for more opportunities in the market. And then going into the position, maybe there's a better opportunity later on, so we ladder into these positions. So for that, we need to leave some dry powder out. We make sure we don't put down 2 to 7%, more than 2 to 7% on any given position. So second thing, always initiate strategies that have over 70% chance of success, and I will show you that on the platform again. We just want to make sure we have the probability on our side, so that we have this edge where we can make money towards the end of the trade. Liquidity is king. We always want to choose the most liquid assets, because liquidity can kill your account by paying too much in slippage, meaning you will pay a lot of money going in and out of the trade, whereas when you trade liquid assets, you would not pay that much high, that high slippage. So you can get in and out of the trade very, very easily without giving up too much. So that is the most important thing. You must always look for liquidity in these assets, in whichever ticker you're trading. And again, I will show you every single thing on the platform. Duration, our sweet spot is between 40 and 50 days out. That's what we trade. That's where we are the most comfortable. So we have enough time to manage this trade if it goes against us, and then enough time to take it off when it hits our profit target. So a couple of things there. Volatility is our edge. We are primarily vol sellers, meaning when we sell options, we are short volatility. So we always sell in high vol environments. Like currently, the environment is not very volatile for certain assets. There is volatility to be picked up in other assets, but In higher volatility, you get juicier premiums, meaning you can collect more premium on these options. And then because volatility is always mean reverting, it's the only asset out there, not price. Price is not mean reverting. Volatility is mean reverting. So when it pops up, it comes back down to its mean level. The mean level for the S&P 500 index is around 14 to 15 VIX. VIX is how volatility of the S&P 500 index is calculated. Allocation, like I mentioned, we do not allocate more than 50 to 60% of our portfolio ever. Anyway, let's go into this long call and long put. Probability of success, like I said, is only 50%. And then let me go on the platform and then show you some long options with call side on the call and put side, and then some short options on the call and put side, and then show you the probability of success here. But just remember, when you trade a long call at a strike of 100, you basically have to cover the debit that you pay. So this red part here is the debit that you have to pay for the option, obviously, to get in. First, this debit needs to recover, and then you start making money on the long side. Same thing on the put side. The stock needs to go down by a certain amount first, and then you start making money in the green. On the short side, this works in our favor. So this is where you sold the short call at 100. And only after 105, because you collected $5 on this trade, only after 105, you will start losing money. And then same on the short put side. If it goes up, you obviously make money, but on the short side, if it comes back down on you, you only start losing money after it goes below 95. So that works in favor of us. Again, probability of success, more than 70%. Let me bring up a marker as well. I need to know how to do that, actually. Maybe I can do it from here. Yes. Okay, that's good. So this is the trading account. I hope that was a shortcut for using a pencil. Anyway, so here's a trading account. Let's go and pick a stock. I think showing a long call, short call, and long put, short put on a stock is a lot easier. And this is my paper trading account, not the real one. So just for like our learning purposes, this is the account that I pulled out. 35 days out. This expiration cycle is 35 days out. And like I said, when we sell options, we sell out of the money options. But when we buy options, which we never ever do, but if you ever have to buy an option, I would always go for an in the money option, not out of the money option. If you buy an out of the money option, you have an even lower percentage of making money on those. Again, let's take a look at this long call. So here's what I was talking about. On the platform, you have to change a few things to make it look like this is the right expiration for you. You have to change the dates on the break-even side here when you set slices, and then you have to change the date here on top. Again, so you're paying $6.85 to buy this option. Your strike price right now, Apple is trading at 222. Yep, that's the mark here. And then again, it needs to go back down sorry, this is a long put, so it needs to go back down by $6.85 first in order for you to make money, and only then you make money. And then let me show you the short put side of this. If you change this here from a buy to a sell, and then let's select a different strike. So we're selecting a 20 delta strike at 210. So let's select that strike rather than 225, which is at the money. 220. Now take a look at this. Yes, you collect a little less premium of 460. But look at the probability of profit here on this side, 68%. So by short put, you mean you want the market to go up. And when it goes up, it is in your favor, which means 68, this is a 1 standard deviation move. And for that reason, you're getting a 68% probability of profit here, meaning 68, there's a 68% chance that the underlying will either stay here or go up or be a little bit further down on you at 207. Now, when that happens, when positions go against you, we have mechanisms to adjust these trades. And when I say adjustment, we convert. First of all, we don't sell naked options to start with. This is a very high risk position because it's a naked option. I'm just selling a put. Short puts, I only use these when I have to buy a stock. So let's say I want to buy Apple at 207 or 220. I would sell a put here, collect $4.60, and then I'm going to sit on it. And then I will let the stock be put to me. If it hits a strike, it will be put to me at 220. That's the way I buy stock and buy positions, by just selling an outright naked put option on it. If I'm bearish on the market, I will go out and I will sell a call option. Again, when we sell, keep this in mind, we sell at 15 or between 15 and 20 deltas. Now this 24 is too far closer to the money for me, so I would sell a call option at 15 if I have to sell. I think I sold a vertical there. I don't want to do that. I want to show you a single naked option. Let's analyze this trade, and then let me show you the same thing. I have to bring the, this is my by default number of contracts, which I need to change to 1. Again, like I said, we don't take too much risk in these naked options. Now look at this. The shaded part here, you have an 89% chance of making money on this trade, meaning the stock is expected to stay within the shaded area 89% of the time, sorry, 84% of the time between now and expiration. That's the probability. This is what we're talking about. We sell high probability trades. Yes, you have to be patient with this. Yes, you have to adjust these trades quite a bit if it goes against you. But you always have an option when you are short on an option. With the long option, you'd never have an option to do anything. If it goes against you, you're just stuck with losing money, losing that debit. However, when you sell an option, you always have an option to adjust this trade, move it to another trading cycle, to another expiration, move it further out. Like I said, duration versus direction. And wait for this stock to come within your range and for you to make money. Again, this is a patience game. You have to be really patient with these trades. Like I said, we sell these things out 40 to 45 days to 50 days. So the trade usually comes in between the first 20 days. So after the first 20 days, you'll start seeing some P&L in this, unless the market goes in your favor right away, and you will see the P&L right away. But if the market doesn't go anywhere, it stays within your range, it will take maybe 15 to 20 days for this thing to come into money for you. Again, high probability trades. That's what I trade. I do not trade low probability. If I have to change this to a long call, look at this. I was selling a call, right? Now I'm buying a call. Keeping everything same. Let me undo this. So I'm buying this out of the money call at 110. Now look at this. This underlying price is supposed to stay within this shaded region 85% of the time. The probabilities have just reversed, right? So if you were to buy this option, there's an 85% chance that you will lose money because it will not even hit your strike price, your break-even price, sorry. You're selling it, you're buying it at the stock's currently at 222. You're paying $1.10 to buy this. Your break-even comes up to whatever that number is. It has to go above that for you to make money. If it stays between the shaded region, you can see this T line is below 0. You will always be negative. Unless this underlying thing goes beyond 241, that's when you start making money. Right? Now, this is when you buy an out of the money option. Look at this. You have a 15% chance of making money. Look at this number here on top right. This is where you make money, right? As a long call owner. It only has a 15% chance of doing it because you're selling it at 15 deltas. So deltas are basically a probability of success. If you were to buy a at the money option, that probability will change to 50%. Yes, for sure. But then you're paying a lot more money for that. Even 250 is in the money. I have to go 222. I have to find a strike for 220 maybe. Is there a 222 strike? Let's see. No, 220 is there. Okay, so we are buying it at 220. That's the at the money. Now look at this. It will change to like almost 50% because it still has a 62% of probability of staying here. Only 37% of probability staying there. Again, like I said, buying these things, these are decaying assets because you see this negative theta. I wish I had a pen that I could use all the time, but this is what I'm talking about. This thing, negative theta. This is the killer for for option buyers. Yes, you get a lot of delta, meaning for every dollar move, you make $73, but the probability of that happening is less than 38%. Look at this. The probability of this thing happening, don't go for these deltas. Yes, you're collecting 73 deltas, meaning for every dollar move, you make $73. But the probability of this thing happening is less than 30%, less than 38%. Because you will always lose money on theta every day. You're losing $10 of this option price every single day. You have some long gamma, and then you have long vega. So when you buy options, you're always long vega. This is the volatility piece. When you sell options, you're short vega. Okay, next thing. Let's go back. Let's go through the take this off. Let's go back to the presentation and see what's going on here. Okay, anyway. Oh, I made some markers on the screen. And do raise these now. Okay. Sorry, this is the first time I'm doing this, so I'm a little rusty here. Okay, let's see. Let's go back to the slides. So here's another very important thing. 5% column is where we stay. That's where we live. Should not go above 10% is max. You should never go below above 7 when you're trading each position based on your account size. So for example, your account size is $10,000. Each trade should only comprise of like $500 to $700 for you. Not 1,000. 1,000 is the max. So just keep this in mind. This slide is where I would print this off and put it right in front of me on my computer when I'm trading these. You should know that you should be within the 5 to 7% mark for every single option trade that you make. Cannot go beyond that. And then overall account usage can only be around 50 to 60%. Now, like I mentioned, we sell volatility. When volatility goes up, that's our edge. We sell the market. We sell these options because now the options are really juicier, meaning we collect more premium, and we have and then because you're short volatility, this thing is due to come down back to its mean level. So if I show you the volatility chart, you'll know exactly what I'm talking about. Let's go back here. This is the volatility curve for the last 1 year /VX. If you want, these are the VIX futures. You can look at the VIX as well. Actually, let's look at the VIX. People are more familiar with the VIX chart. Okay, look at this. If I have to draw a line here, volatility for the last 1 year has stayed at 13%. Okay, perfect. So how does that help us? Well, these are very lull markets, meaning not much was happening here. So you could have sold options and you would have made money all year long. Meaning because the market has just gone up. When market goes up, volatility comes down. So and then if you want to check that, let's check SPX chart, right? For the last 1 year. Well, 1 year. Look at this. A hockey stick kind of move to the top right. That's what SPX has done. And when SPX does that, when it goes up and up to the right, volatility stays low or it doesn't go anywhere. Anyway, it did go somewhere. on August 5th, I think this was August 5th. Yes, if I have to hover over it. On August 5th, volatility popped up to 65 overnight, right? It was going up, and then through the night, it just went up because there was a yen carry trade, and a Bank of Japan basically started raising rates. So that's where this vol thing popped up. But look at how it comes back down to its normal level. Look, so if you were to short, and then I shorted some put spreads here. I shorted some put spreads here because the market was down so much, and then negative volatility, it just made money here. Look at all the drop here in volatility. So volatility is always a mean reverting asset. If you have to go back 50,000 years on this, it will still be the same thing. That it comes back down to, if I should change this chart to, let's say 3 years weekly, let's do that. Look at this. If I have to draw a line here, it go up, comes down, goes up, comes down, goes up, comes down. That's what it does all the time. So when it goes up, we sell this vol. And then when it comes down, that's when we take the positions off. Basically, the idea is when the vol pops up, you sell the options, and when it comes down, you take the options off. By then, you would have made enough money. And if you haven't, then you roll the position, you adjust it, you do whatever. But remember, volatility is a mean reverting asset. It always comes down to its mean level. Therefore, we sell it when it pops. Let's get back into our presentation here. Okay, so that's what our edge is. As option sellers, this is our edge. You can read into this. Hopefully, I'll be able to send this document to everyone so you can go through it. And when it goes up, here's the bell curve of a normal distribution, the normal distribution curve for a asset price. What this is showing is 68% of the time, here around where my mouse is hovering, 62% of the time, the price stays within one standard deviation of its mean. So SPX's price, if you were to draw a normal distribution curve on it, on the returns of SPX for the last 20 years, you would see that 68.5% of the time, the price has basically stayed within one standard deviation of its mean. And that's what we sell. When I showed you the Apple short call option market at 15 deltas or 17 deltas, that is one standard deviation move. So we will sell it at one standard deviation out, meaning we are already expecting this price to stay within one standard deviation of all the moves. 95% of the time, this price stays within two standard deviation. And then three standard deviation is like 99%. But if you go further out at three standard deviation, when I say 2 to 3, you don't collect enough premium. So here's how to look at it on the platform in real thing. If you were to go select again an Apple position, go to the trade tab. Now this is 20 to 17 deltas is one standard deviation. I think 10 deltas is around 2 standard deviation, but look at the premium there. Because the price is only expected to touch this level around 10% of the time, because what is it, 95% of the time, the price is supposed to stay within 2 standard deviation, meaning from here on, it will stay within 10 deltas. So 200 to 245 within a 45-day period. There has to be some period around it, right? So that's how they calculated this expected move here on the top right. If you look at it, let me bring my marker again so I can show you. This is so annoying. Maybe I'm doing something wrong here. Okay, here. So now I want to go back in my, and I cannot do it. I have to cancel this here. Anyway, so look at this on the top right here where my mouse is. 25.30% is the volatility. Inside the bracket is the move. One standard deviation move, $13 or $40, you can call it, right? So $40 from now, this is how you read the option chain. Again, a good insight here if you're looking at the platform. The price currently is at 222, $14 down, and then $14 up. That's what this expected move of 1%, 1 standard deviation is showing. Now, when volatility pops up, this expected move widens out, meaning then you can sell these options even further out on both sides, puts and calls, both sides. So that's how volatility affects these option prices the most. Right now, because the vol level is around 45, and if you want to go to the chart and look at it, it did pop up here in September, early September, last year. And then this whole past year, it has just stayed within its range, around 23%. So yeah, that's what it is. The next part of the, let's go back here again. Okay, so the most popular tickers that we trade, again, take a look at these. We trade some index options, we trade commodities, we trade everything basically that is out there on the futures options market. And I've given you some spread width. This is what I trade. I don't go 30 points out. I don't go 40 points out. I don't go. This is what I do. 50 points out on NASDAQ, 20 on Russell, 20 on S&P. These are my set trades. Oil, I would never go beyond 1 point, one strikeout. And I will show you now, when I say the spread width means that if you are buying and selling an option. Again, like I said, we don't sell just a short put or a short call, even though those are high probability trades. It requires a lot of capital to put down. It requires a lot of capital to initiate. So we don't do that. We sell spread widths. That's what my target is, to teach everyone at least one strategy, which is low buying power effect, meaning low capital required for that strategy, which is a credit spread, a short credit spread. So, and that's what I've been doing all year long, shorting either the call side or the put side. Call side or the put side. As a contrarian, I sell when the market, whichever way the market has gone. So for example, the market goes down, you sell a put. When market goes up, you sell a call. Because if you sell in the market's direction, you always get good premiums. The point is to collect good premiums here. Again, on the currency side, we trade euro currency, British pound, gold, and on the metal side, we trade gold and silver. Silver is a big product for smaller accounts, so I kind of stay away from it. Gold is a good product. And all of these are like very liquid products. You don't have to worry about liquidity here. You can get in and out of these products very, very easily. I wanted to show you this correlation matrix, which I created recently. S&P, look at this middle part here where my mouse is. This is where S&P and SPYs and NASDAQs are. Sorry, S&P and NASDAQ, right? Very high correlation. But look at the other correlation. So the bonds, the TLT's correlation with oil is negative. If you want to check TLT's correlation with, S&P 500, it's around -22, meaning you have to trade different underlying assets, different tickers, to diversify your portfolio. You can't just trade the positively correlated assets, because then your portfolio is not really that diversified. So when we trade multiple different underlying tickers, meaning we will have at any given time a index position on. Indices, you would notice, like very highly correlated, right? So if you have a position in Russell, you don't need a position in S&P. That's what I'm trying to say, because they're both very highly correlated. Or NASDAQ, S&P, either one of them would work. On the other side, you should have a position in bonds. Then you should have a position in oil, commodities, and then gold, and then currencies. This is how you diversify your portfolio, by diversifying all these asset classes. Okay, now module 3. I hope I've given enough background. I think I've left the chat option open. If anyone has any questions, I can just take a look at it right now. If not, then we can go into the third module right away. Just post your questions on the chat. See if you have anything that I can explain through the course. Cover call options, again, you buy the asset and then you sell a call option on it. That's basically cover calls. But you should have the assets in the account, or not necessarily. You can do without it too, but then you'll have to put down a lot of money. Okay, I have no idea what that was, but yeah, let's turn it on. Okay, so cover call. I was trying to show you cover call. So here's my trading account, and I purposely did this so that I can show you exactly how these strategies work. So right now we just go out and buy, Apple 100 Apple stock, right, at whatever price it is. And this is it's a paper trading account, so it gets filled right away. So you should use this to practice. You get $200,000 to practice here. Always use this account, put positions on, take it off, and then just learn the systems, learn the methodologies, learn everything through this. So let me buy this, and then I'll show you how to sell cover calls on this. So we put the order in. There you go. It got filled, right? Doesn't matter wherever it got filled. The next thing we will do is again sell the options on him. So it has a 42-day cycle, but it's a weekly cycle. Now, weeklies does not have enough liquidity. Now, if you want to see here, open interest and volume columns, it doesn't have enough in there, right? Look at this. Now, if you want to open the monthly cycle, which are all the gray ones, even the 35 days out, look, thousands of strikes, thousands of open interest, meaning each open interest contract has thousands, each strike has thousands of open interest on them. This shows that the expiration cycle is liquid, plus the underlying asset is also liquid. So now that we have a stop position on, right, if you want to do a covered call on it, all you would do is go onto the call side, and then you will short the call. Now, two things you need to keep in mind here. At what level are you willing to give up the stock? So let's say you bought it at 222. Let's check our price, where we got filled. We traded at 222.42, right? So if you're willing to let this stock go at, I don't know, whatever your profit targets are, at 235, you would have made $12 on it. 100 stock, $12, that's a lot of money. You can sell this single call option. Now remember, each one option controls 100 shares. So you bought 100 stock, right? So you can only sell one option to stay one-on-one with these. If you sell two, it will require. Now, check this difference. If you sell one option, your buying power is basically nothing. Look at the zero line, right? Because you already hold 100 stock. Because if it was ever going to get away from you or called away from you, you have the underlying asset to send away. That's why they don't charge you more money to put down. They don't ask you to put down more money. Now, if you were to sell two call options here, you're like, okay, I'm going to be a little bit greedy here. I think the markets are going to be bearish. I need more than this. So I'm selling two call options. Now look at the buying power effect. You have to put down another $3,000 to trade two options. Fine. So always sell however much stock you have. If you have 200 stock, sell two options. Fine. I'm fine with that. But if you only hold 100 stock, only sell one option, right? Let's undo this. Okay, let's try and sell it in the market, whatever it is. I just want to get filled to show you. So I'm not paying any extra money because I've already bought the stock. I hold the stock. I'm only just selling the call option on it. So that's why I'm not putting down any money. Now let's see the chart on this, right? But you're paying 65 cents to trade the option. That's all you're paying. 65 cents is TD Ameritrade's or Schwab's option commissions. Let's send this out. It got filled right away. Now let's look at the analyze tab. So here was your I need to reset this a little bit so that the charts come up right. Okay. Again, select your break even. Select this from here as well, October. And that's how your break-even looks. This is what your chart looks now with the call option. I wonder why it looks a little weird. Okay, this is the short call. So now let's quickly go through this because we have to cover a lot of other strategies here. Again, you have a limited upside because you're only going to make as much money as you have collected in premium. So 191. Wait, that's the yeah. Why is it showing as I bought a call here? Man, that's my bad. Did I sell this? No. Okay, this is the position. We have one short call and one long stock of 100. Okay, so you have limited upside because your upside is now capped, right? It's capped at wherever your stock goes from here, plus whatever the premium you collect. Now, if it goes beyond the strike where you sold it, 235, beyond that, you do not make any money. So you need to keep that in mind that you're willing to let it go at 235. At that point, your stock has already gone up $12. So that's a positive thing. And then you have collected $2 and $1.90 or whatever on the call option. So if you add all those together, then you have made enough money. Stock going up when you're trading cover calls is always a good sign because that means your stock position is going up. And then when you have to, at expiration, if the stock is sitting at, let's say here, 240, let it go. You made from 222 to 240 on the stock, plus you've collected 190. So that's quite a bit of money on this stock position. Once you let it go, you then go out and sell the put if you want to hold the stock again, if you want to own the stock again. Now this is called the wheel strategy, but there are certain, do not go out and trade this. I'm just showing you the short call. Don't wheel this out because wheeling has a downside risk, meaning when you sell the short put, the risk is that it can go beyond your short put strike, and then you're stuck with the stop. There's certain different things that you have to look at when you do a wheel strategy. But this is the short call, cover calls. Always do this. When you hold stock, and if you're willing to let it go at a certain point, sell the calls on it, let it go. If you don't want to let it go, sell the call and then adjust the call. If it's in the money, adjust the call. I also use the short call option on my stock positions to hedge some risk. Meaning if I'm holding 200 stock, I may sell one short call that reduces my deltas. That gives me some downside protection if the stock position goes down. Next one, let's quickly go through other ones. I hope I'm not going. Anyway, cash secured puts, like I mentioned, you always go down and then sell a short put. To cash secured basically means that you have enough cash in the account to buy these assets that you're selling the option on. So let's say you wanted to buy the Apple stock at $200, right? Current price is 222. You want to buy this at 200. So you would go sell a short put at whatever price. I mean, you can adjust your price here, but you will collect 91 cents, meaning you will collect $91 here to sell the put. I mean, this is 10 deltas. I don't normally go that far out. 14 to 20 is good if you want to own an asset at a certain point. 14 to 15 to 17 deltas is a good spot. The only risk in this one is cash secured that it may never hit your strike and you will always be selling a put. So if you want to own the stock right now, go buy the stock. If you can wait and collect some premium on it and reduce your cost basis, always sell a short put option and sit and wait until it comes to you. And then once you have it, you own it, you think it has certain potential on the upside, go sell a stock call option after that strike. And that's how you get rid of it. Don't just go out and sell the stock, sell a call. And then, let the market come to you. Don't sell stock outright in the market. Sell a call option on it. Let it get called away. That's the strategy. Next one. Again, cash secured puts. I've just showed you how it works. It's you're short put, so you're long the market. So the market is supposed to go up on you. This is my favorite one, short put strategy. perfect strategy. When the markets go down, people are scared and the premiums are juicier. So the put side always has more premium than the call side, especially in indices and other major products, like stocks as well. Some stocks. The put side always has more premium to collect because people use put side to buy puts as protection. So when they bid up the price of the put side, it becomes juicier and juicier. So that's when you come in and sell those puts at a higher premium. That's the game. Now, what was I saying? Oh, short put spread. So we can stay. Let me now take you into the futures options world. This is the S&P 500 futures options. And this is what the chart looks like. I'm just going to sell a short put strategy. Actually, I'm not going to sell it. I'm just going to set it up. I think we're selling it in some other module later on. We don't even have enough time here, so I'm just going to set one up. So again, what do I do when I set it up? First of all, the expiration cycle is not enough for me. I need to find somewhere between 40 and 50. This is a weekly one at 42. I will always check the open interest here. That's why I have open interest and volume as my setup. Not enough. I will never touch this. Remember, liquidity is king. If you wanna compare, look at this volume volume and open interest here on this side and then this side. Now go back and look at it in the a monthly cycle like this one, 63. You can start seeing thousands of these strikes from a very low point. Like in the other one, at this level, there was nothing going on. There was NAs. You go down here, there are thousands. There are thousands of them. So again, liquidity is king. If you end up trading the weekly cycle, you will end up hurting yourself when you would try to get in and get out of the trade. You will always be paying more to do it. Anyway, okay, this is fine, 63, just to like set it up. So again, delta is my main thing. This is my probability of profit. If I select 17, meaning I am collecting more than 80% chance of this trade being profitable for me. Again, what am I going to do? 50 to 60. Actually, let me just take you there. So the market is up $21 here today, 21 points, which is fine. You can still set up a put spread. Usually at this point, what I'm trying to say is I would have sold the call side. So let's do what I would have actually done. Oh, just something. There's something in the chat. What does it mean? Is it current price or price over some time? It's price over some time period. So mean is like, if you're calculating a standard deviation of, let's say, last 1 year, so it will take the mean and then it will calculate the standard deviation, right? So the mean will be the price over that 1 year, which would not be, because it's a moving target, the price is always moving. It will not be too different from your current price. Because it's a moving target. So this standard deviation will keep going up as the price goes up. So when you look at the platform, you know that you are in the current market setup. You're not basically trading a standard deviation from 1 year ago, right? Even though you've done it, you've calculated over 3 years, fine. But when you go into these platforms and you look at the expected moves, these expected moves are calculated based on price right now, and then it's standard deviation around it. That's how these expected moves are calculated. So standard deviation is always run on historical price returns. Fine, we know that. Implied volatility is what affects these options, and that's how these expected moves are calculated. So implied volatility is forward driven, meaning it is calculated based on what is going to happen in the market, not what's happened in the market. What's happened in the market is historical vol, not implied vol. So there are two different things. Anyway, I was setting up a short call option here because that's what I would have done. The market yesterday was crazy up. Fine, good thing. The market today is up too. So we will sell a short call option here. Again, sweet spot is, one more thing I should mention. I don't really like selling calls in indices because the market has a positive drift to it. Meaning if you calculated the number of times or number of days the market goes up versus the market goes down, it's 70-30. 70% of the time the market goes up. 30% of the time the market goes down or stays in a lull environment, or 20% of the time, whatever. That ratio is high. So I've lost money selling calls. Even though I like selling calls because the market has gone up so much, but I would sell calls in other products, meaning commodities, interest rates, gold, metals, all those kind of stuff, not indices. Indices I feel like there's a big herd of people that come into the market every morning and then they just go out and buy this asset. So when there are a lot of buyers, the market goes up. When market goes up and you're short a call, it has a higher chance of breaching your call. So even though the market has gone up, I haven't traded a short call all year, maybe once or twice. End of last year, I remember I was trading one on Russell, and it wasn't a good trade. But again, be careful with short calls on indices and outright ETFs, because again, 70% of the time the market just goes up. 75% of the time, I would say. So we are careful in shorting calls. Anyway, this is what I would have done if I desperately was trying to look for a trade. I would have sold this strike, 59.75, because look at the strike below it. There's no open interest, there's no open interest, and then there's no volume in there. So I would not have sold that strike. I would have sold the 17 deltas, which is my sweet spot anyway. Sorry, 18 deltas. Okay, shorting a vertical. This is how I would set it up. I think we are running out of time. We have to be quick. So I said I normally do 20 bit. So the width of my S&P strikes is 20. So if I'm selling it at 59.75, I don't find another 20. So now in this case, I have to take 25. Fine. I can do that, or I can go back down to 59.70. Again, there's not enough volume in there. It's weird that this strike does not have anything, then the one after that has got a lot. It's weird, but anyway, I can take 59.70 and then I'll do $20 out, right? For education purposes here. Again, my width by default is $20. I don't think I've ever done more than that. So so you're collecting $4.50, which is a good premium. But you have to divide that in two or half for it to for your real dollar amount. So change these. Look at this. 97%. That doesn't look right to me. Something's off. Yeah, I mean, this should not give us 97%. But anyway, for learning purposes, this is how you would set it up. Don't look at this number right now. Maybe something's off somewhere because it's a trading account, maybe. This does not happen in the live account. But I mean, anyway, the shaded area is well within your range. Even if this was like a true number, this would be well within your range. Anyway, this is how I would set it up. On the call side, I also go and look at the top of the market. The market tops at 5,700 in this product. And then I would have gone beyond that to sell it. Anyway, short put, best one. Read through it. This is how you short put is the other way of the example that I showed you. But let me just set up a short put as well, very, very quickly, just to show everyone. This is how I would have selected the strikes, expirations, and everything. 63 days out is okay. It's too much. I would not have traded this that long. Again, my sweet spot is 40 to 50 days. But I would have selected 17 deltas here. Not this strike, because this strike does not have enough. I would have selected and the reason we're seeing low volume in this one, because we are 63 days out. If you want to check more volume, you can go into this one, the 35 days out, week 3. Let's see. Now look at it. It's like thousands, right? And there's another thing about these futures options, that each of these expiration cycles, they underlie different future. So look at this thing here in the middle, Z. So this means that this one is underlying the December contract, which is 98 days out. That's what this option will expire into. Every time a futures option expires and there's a delivery to be made, it it will settle into a future. Which future? In this case, a December future. Fine. That's how these futures options work. That's all there is. There's nothing more complicated about this product. 54.10. We would have sold it here. 54.90. Yeah, this looks more like a reasonable credit. 225, meaning you will collect $1 and something on this trade, but with a higher probability of success. Now, a couple other things you have to look at is, by the way, you can change your probability range from here. So if you scroll down here, one standard deviation is 68%, you can move it to two standard deviation, and now you know that at expiration, this product is supposed to stay within this range at 2 standard deviation, right? That's where it will probably end up 95% of the time. You can change it to look at a 3 standard deviation. That's just unreasonable. You don't collect enough credit to do that thing. Okay, a couple of things to look at when you set up a short put spread. 225. So when you hover over it, you collect 112.50. You just have to half this exactly, and then this one trades at like 25-cent increments. So $2.25. Next price will be 250. So if you select 240, it will not work. You have to be at 250, 275, 3 like that. Max loss is 875. So $1,000 minus the credit that you're collecting. Your buying power, look at this buying power, 329. Now, if you were to select okay, now look at this thing. Your buying power is 329, right? Let me show you the difference between an SPX option and S&P futures and the futures options. The big difference. So keep this in mind. You're collecting $120 and you're paying down $329 for it, right? So to collect $120 in an SPX option, look at how much money you will have to put down. We'll try and set up the similar trade. I think this was 35 days out. Let's do the same thing here. 34 days out, I think they should work. 35 is here. Let's do that. Going down to like find the, and then the strikes will not be the same, but I'm going to select my sweet spot at 17, and then whatever strike that comes in at, right? Will typically 70. Now you have to realize that futures have this contango thing built in, meaning they're always higher than the spot. So they're supposed to have a higher value based on the cost of carry. That's all you need to know right now. So that therefore the strikes will not match, but the deltas should. So in order to collect similar amount of money, and this is just for for teaching purposes here, you have to go back down to from 53.70. I think I think this one gives us $120, same as the other thing. Does it? No. Yeah, 117. It gives us 117. Okay, close enough. But look at the buying power effect, 3 times more, $880. So if you have to collect the same amount of money in an SPX option, you're putting down 3 times more money. That's why we trade futures options. And this is what I wanted to show. Like, why do we trade futures options? That's the only reason. Anyway, next one, quick. Advanced strategies. Okay, strangle. So I've showed you short put, I've showed you short call. When you sell both sides at the same time, that's when it becomes a strangle. So at 17 deltas. Now it's a neutral strategy, meaning what you're saying is that the market will stay within a range. And that range is basically at 17 deltas from certain point. I normally do short puts and short calls. I don't go neutral because, again, my problem is the market is not neutral. The market is positive all the time. 75% of the time it's positive, meaning it's always positive for me, right? So you have to select a strategy where you take some directional risk. Even though I don't know nothing about this direction, I would take, as a contrarian, I would sell the side where the market has fallen or the market has gone. So you call this a selling into the strength of the market, meaning if it goes down, you sell the put side. And Anyway, the idea is to show you, but strangle is a very good strategy. I like this because it's an easy in, easy out, easily manageable. Don't worry about the naked side of it because we manage these trades. We don't just let it run, right? We have a mechanism to manage it. Again, how do we manage? I want to show you that on the vertical. Once the vertical is tested, we convert that into an iron condor and then we stay there. An iron condor then collects some premium data, and then we move that into the next expiration cycle if it hasn't collected enough premium yet. Now I'm showing you a strangle to you. Again, 17 deltas, 50 70. Why am I in SPX? I don't want to sell a strangle in SPX because it will cost me too much. To make same amount of money, I'll be putting down three times more. So I don't do that. Let's take a 35 days expiration cycle here. And then sell both sides. When we sell both sides of the market, it becomes a strangle. Now that's a strangle at 5,400, and then I'm gonna go. 16 is fine for me. On the call side, the further out you are, the better it is because, again, like I said, the positive drift, meaning the market goes up more than goes down. So further out you are, the better, but it has to make sense for you to collect enough money as well on the premium, because the further out you go on the call side, less money you collect, right? Anyway, 16 is fine. 58.90. Actually, let's round it up to 5,900 on the call side. So my put side is fine. On the call side, I'm going to 5,900. It still make, if I were to do this in my real account, it would still make me really uncomfortable selling at 5,900 because I think it can easily go through 6,000 by the end of this year. But this trade is only 35 days, so you just don't know what can happen in the next 35 days. But it's a good trade in terms of how much money you're collecting versus where the market can actually go from here. So 1019, again, these probabilities are a little bit off. But look, you're collecting $2,000 by selling both sides. Now, it's one of our favorite strategies. Don't get me wrong. Really easy. Don't get scared about the short naked sides here, because we know what we can do and what we will do when the market goes against us. If it goes up to our short call strike, we will move the put up. If it goes down towards our short put strike, we will move the call down, but not as much, because again, we don't want to touch the call side much because the market will then go up on us, and then we don't want to be banged on both sides, right? So nice credit, but look at this. The amount of money you would put down on this, 4,400, you're collecting $2,200. You will end up paying quite a bit of money, $10,000, right? But you're collecting a lot of money too. So even if you collect $1,000 out of this trade, right, and you've put down $10,000, that's still 10%, right? That is still 10%. So you can make 10% on this, and if you can do this 4 or 5 times a year, annualizing it could be around 40 to 50% just on one ticket. Again, you have to think about commissions. You're paying $4.50 to get in, $4.50 to get out. Plus, if you have to adjust it, you will pay a little bit more. So even after adjustments and after paying more commissions on the adjustments, we end up making more money on the options side, on the futures options, because we're only putting down 1/3 of what we would put down on an SPX or something else, or an SPY. SPY is even more expensive. And then we can do 3 trades for the price of 1, versus a SPX or an SPY. 12:30. Okay. I think I'm running behind. Let me just cover the short strangle I've done. You can go through this. If there are more questions, obviously just send me an email. Short straddle. Let me show you a couple more on the platform. I think going through the platform is my thing rather than going through the slides and talking about it. We'd rather do it here, just so I can show you like how it works. I mean, short straddle is just at the money. You collect more premium because you are at the money, but your probability of profit goes down because you're at the money. Couple things. Whereas, and we can discuss all the other ones, the butterflies, the iron condors, everything. I can take you all through different strategies. What else? Okay, I'm showing you the straddle. Again, like I said, we're selling at the money. So when you sell at the money, you're selling the same strikes. So you're selling 56.90 on both sides. You collect more money, but then your probability of profit now is slightly lower. It's around 47%. Yeah, it's around 50 to 55% usually. Sell a straddle. I don't normally trade this. I don't like the width that I get. I would rather be one standard deviation out so I can cover the whole shaded area and just sit outside the range. I don't like to be within the range. So here, what this is telling me is even from today, like right now, the underlying asset can either go up to 66,000, like 6,000, 60, yeah, 6,000 something. And then it can go down up to 5,400. So I would rather set a strangle and adjust it if I need to versus collecting this. But look at the amount of credit you're getting, right? In the other one, in the strangle, we were collecting $44. Here you're collecting $188. So 44 points, meaning $2,200 you were collecting. Here you were collecting 188 points, which turns out to be $9,000. You will also put down more money on this. 11,600. Not much different, but again, the reason we wouldn't do this is because, again, it doesn't give us enough width for the market to move on us. And especially if it's 35 days out, the market can move quite a bit, but it is a strategy that is out there. Next one. I want to leave some time for any questions that I have. Short straddle is here. Iron condors, last one. Iron condors, very simple, very good strategy. We use it a lot for trade management. To set it up, again, we'll do the same thing. Let's go to a 17 delta here. Same thing, 5,400, but I'm going to sell a iron condor, right? And I'll go $20 out on both sides. That's the name of the game. So from 5,400, I'm going to go 5,380. On the call side, I need to know where the 17 deltas are, and I'm going to sell that. Actually, let's put this straight in to see how it gets filled. So 16 deltas are fine. I'm going to go by 58.80, actually 18 deltas, 58.80, and then 9,800. So my short call is going to be 58.80. This is how you set up an iron condor. I hope you are making some notes here. Because you will need it to know how to actually set these things up. From 58.80, I'm going to 5,900. Okay, 5,900. There you go. That's my setup. Okay, change this back to one. Don't sell more than one on each asset because you will be diversifying, right? Yes, if you have a bigger account, $100,000, then I will suggest that you do max two, no more than that. Make sure you don't go beyond that 7 to 8% mark on each trade of your account. 98% again wrong. I don't think that's right. I don't know how to fix it. This should have been a 65 to 70% probability of success here. Something's off here on this platform, but anyway. So I'm collecting $6. Let's say we collect $6, right? Now remember, because you're trading four-legged options here, it's a little bit difficult to manage. Meaning, if you have to move this whole spread out to a different cycle, you have to move the whole iron condor, buy it back here, and then sell it in a different one. So we start with two-legged options, meaning we start with a two-legged strategy. It's a short put or a short call, and then we convert it into an iron condor to manage if it goes against us. Then we try to move the whole spread out depending on whichever strikes that we sold. Each future option cycle is different underlying future assets. So it depends which one are you selling. If it's the same underlying future, then you can move the whole spread from this month to the next one. If it's different, then you have to do it individually. Anyway, a small tip there. So here I am collecting $300 because I'm collecting 600 here, right? My max loss is 1,000 minus 300, the amount of money I'm collecting. That's 700. Look at the buying power. It'll be really low. Well, not that low, but yeah, 492, which is good, not bad. For a short put, I think we were putting down 300 and something dollars. For this one, we're putting down 492. Because you're selling both sides, you're collecting more money. They charge you for I think they charge you for this. This all works in span margining. I will discuss this later. You don't need to know that right now. Anyway, overall, again, it's important to like bring this up for portfolio management. Remember this slide, print it out, keep it on your computer. I've put some Greeks in here to show you how this short call, long put, short put are affected by delta, gamma, theta, and all these. For example, short call is negative. And sorry, the deltas here. So this is how it goes. You have to read it horizontally. So the delta for a long call is between 0 and 1, positive. Price goes up, option price goes up. Actually, I never showed you the deltas. I kind of forgot. For an iron condor, these are the deltas. They're all the deltas are going to be neutral because we are selling a neutral strategy, right? So here, we're not collecting any deltas here. You have to look at the 0 line because the other lines are like plus minus 10%. So deltas are flat, gamma is flat. I'm collecting theta on both sides, $5, and I'm short Vega. Short Vega means because whenever you short an option, you are short Vega. Fine, you can look at it here. So Vega is here, number 4. For a short call, the volatility is negative, meaning when it goes up, the option value will go down. For a short put, again, it's the same thing. If it goes up, option value goes down. Anyway, take a look at this. This is a good chart to like, again, print out and keep it there. This is the same thing, but just highlighted, like in which case will the option price, which ones are negative, basically. Which ones affect the option prices negatively? Which Greek affects it negatively, meaning, for example, delta for short call is negative, right? For long put, negative. Fine. Interest rates, negative. I've talked about liquidity. I've showed you how to look at open interest and volume. Bid-ask spread is obviously the most important thing for liquidity. Check this out. So let's look at the bid and ask here for a 17 delta strike. I'm looking at 5,400 here. So the bid ask here in the ES product is 28.75, 29.25. So 50 cents, right? Now, if you want to look at the same thing in a different cycle, well, let's say you pick up a 42 days out cycle. Same thing, 17 deltas. Let's go there. Let's take a look. Okay, slightly more, right? Well, a lot more. 36 versus 36.50. Well, 50 cents here, not bad at 19. At 17, it's the same thing. Again, ES is a really liquid product. If you really want to see the low liquidity thing, go check out, which one should I say? Check out one of the stocks that is non-liquid. You have to just go check. Fine, I'll give you a list of things that are non-liquid, but this is how the liquidity works. The bid-ask spread, meaning you're only paying up 50 cents to get in and out. For example, you sold something right now, you want to buy it back right away, you will be paying 50 cents on that spread, right? Because look at this, if you buy this right now, it will cost you 51.25. right? If you buy this futures option at 5,500 straight, it will cost you $51.25. And as soon as you buy it, you turn around. This is how I look at bid-ask spread. If you want to buy, you bought it, right? And you turn around and then you have to sell it to the market maker again. They will only buy it back from you at $50.25. So you've already lost 25 cents. Let's say the market does not move and you turn around, you sell it right away. You will end up paying 50 to 75 cents on this. You will lose 75 cents right away. I've already shown you, the open interest. What else is left? Short, all these straddles are done. I've shown you the Greeks. Real trade example we've done. We set up the trade. I've showed you everything. Defending part, again, like I said, we convert this into an iron condor, and then we move the trades out. Okay, let's go. We have 12:41. We have 15 to 20 minutes. Let's take any questions that are there. Let me see if anyone's typed anything. So does anyone have any questions? Anything you want me to take a look at on the platform? Yes, I can share the PowerPoint. Although I don't know how to, so this is an Eventbrite thing. Maybe I can attach it and then send it. So I'll try that. I wanted to show you something that I forgot. So here's how. Let me share again. Here's how you can stay in touch. Actually, I think what happened? Am I sharing it? Not yet. Okay, here's the layout. There you go. So this is how you can stay in touch. So go check out, obviously provide me any feedback that you have. Email me anything, any questions you have, email me. I will respond to everything and anything. Check out the YouTube channel. I have some videos there. Take a look at it. It's called the Long Short 101. I'll type it here. The long short is basically the long and short of the market. I think that's what the handle is on YouTube. And then join the Discord channel. This is where I discuss most of our strategies. Whenever I'm putting a trade on, I will always discuss it, my thesis behind it, how I manage it, how I trade, and how everything goes on. Okay, here's my real year-to-date P&L. Oh, are you seeing this? Is everyone? Okay, I'm sharing it, yes. Okay, so you can see the positive P&L I've made, right? No, I've blurred out the stock position that I have. I don't know if I can show this, but anyway, futures option positions, I've only traded these because that's what I'm allowed to do right now, with certain restrictions. And you can see the last 4 or 5 are like my equity positions. Some are positive, some are negative. That's just fine. Here, what I want to show you. So these are tickets I've traded so far: Euro, oil, S&P, Russell, bonds. I haven't traded NASDAQ. I thought I did trade NASDAQ, but maybe not. I haven't traded it. Anyway, you can compare this. So 411 bottom here, and then 411 bottom here, on top here. It's a small account, so I only take small positions, one contract, and I've not really been active this year as much as I would have liked to. First 3 or 4 months was like really inactive for me. And then I started picking up a little bit. But anyway, what I'm trying to say is selling options, even with the positive drift in the market, you want to see how much S&P has gone up, right, this year. Fine, you can do your calculations, probably up 20, 13%, whatever. But on an annualized basis, if you keep on selling assets, if you keep on selling options, if you have a decent enough account, let's say I would say $5,000 to $10,000, you can make consistent income. And the reason to show you this is like, I mean, I'm not hiding anything. There's negative P&L in Russell. Fine, I need to claw some of the money back. But every other ticker, I've been able to, like, whereas oil market, I've made some money in the oil market, right? Now look at where the oil market is right now. I'm currently short puts in oil, just to let you know. And I have a video on my YouTube channel when I put it on. So go check it out. Let me actually show you that. This is the channel. Check the oil video. I think it's somewhere in there. Like, how did I put it on? And it's in the money right now. I was short put when it was down a little bit more than here. Anyway, I was showing you what oil has done. Nothing, basically. You see this? It's a flat line all year long. But I've been able to make money because, again, we sell these We sell options here. So when you sell it, you don't really need this thing to go up or down for you. You just need this thing to, you want to trade this mechanically. When IV goes up, when volatility goes up, you sell it. When it comes down, you take it off. That's the name of the game. Anyway, yeah, I mean, small P&L, fine, but I'm still positive. You know, a lot of people have lost money maybe buying options. You know, selling options, I'm telling you, it's a really good skill to learn, to trade, to do whatever. Anyway, any other questions? If we don't have any more questions, we can give some time back to people, and then I see Sean is unmuted. Do you want to say something? Can people say something? Oh, manual. Okay, best broker. My favorite one. No commissions involved. Obviously, this is my first time doing it. Is toss, which is think or swim. And I have a video on my YouTube channel on how to which kind of option approvals you need to create different kind of options. So check that out as well. How to get that done. Commissions for futures. Basically, here's the thing: for futures options, it's the exchange, the futures exchange that charges more. So CME, because these are all products on CME. So CME, there's a CME fee involved. The actual broker fee is probably same everywhere. I mean, I'm still paying 65 cents for other option trades. But for futures options, you end up paying a little bit more. So in commissions, because there's an exchange, the futures fee involved. Was there anything else? No, so I've gone through a lot of different stuff here. Hope you guys have made some notes. Where can we learn more about IV and HV? That's a good point. There is, I don't know if there's enough material out there, but I'm in process of creating a beginner slide where I am going to talk about all the volatility stuff, because that's what our edge is. We sell vol. So the idea is to like teach people how implied volatility and historical vol is easy to calculate, easy to work with, because you already have the prices, right? So you have the back data, you have the time series. All you need to do is just convert that daily price into returns and then calculate volatility on it. And then on the rolling basis, meaning you want to do it on a 30-day rolling, 6 months rolling, 1 year rolling, whatever, you can just check what historical vol has been. But implied volatility is a little bit more complex, meaning you have to go forward in time to calculate it by the option prices. So that's a good question. I hope I can find you some good material on it. Let me Google it as well. I think I have some papers saved on it. So if you can drop me an email, I can probably send it back to you when I find something to learn on that historical and IV. IV is the most important thing to learn about in option selling, because that's our edge. We sell options, and basically we sell implied volatility, which is mean reverting. It's a mean reverting asset. You can go check a chart of anything that is out there. It is not going to look like the IV chart or the VIX chart, because the VIX chart is mean reverting. It goes up, it comes down, it stays there. It stays there. Okay, how many times does it go up? Like I said, my personal experience, it doesn't go up much. 30% of the time, it probably stays 20 to 30% of the time, it probably stays low or up, right? 70% of the time, 70% of the time it stays long, like in a range. 20% of the time it goes up. 20 to 30% of the time it goes up. So that's when even when it's in the lull state, you can sell the market, right? You can sell the options, because you know the volatility is stable, meaning the market is not going to go too far out from here. So you can either go neutral, or again, it's hard to pick whether you want to go neutral or pick a side. I'm a contrarian, so I normally trade wherever the market has moved. So if it's going down, I would sell it. So I'll sell the put side. Manual, yes. Man, I'm gonna try. See if I can email everyone the presentation. Let's see. Whether Eventbrite allows this or not. I don't know how else to do it. But yeah, I'll try and email everyone for sure. So I will send the presentation. Any other questions, anyone? Sorry, the tech thing was like a little bit off for me. Again, first time, so still learning how to do these presentations. But anyway, if nobody else has any more questions, then we can sign off. Give everyone some time back. Thank you for joining, and then nice. Thank you, Vishal, for the thumbs up. Thank you for joining, and then I hope to see you all in my next one. In my next class, which will be more about so I'm going to talk more about one strategy next time. So I think this time I put a little bit too long of a module in there. Even though we had an hour and 30 minutes, it's fine. I think even for me to talk about so many things, it was like, it was too much to digest for everyone. So next time we will laser focus on one strategy. I will teach you how to trade short spreads, short call spreads all day long. How to make money on those, how to adjust those, how just basically all and everything about short put spread, which is basically a short credit spread, right? So that's what we will learn next time. And in the meantime, your homework is hopefully go through the slides, learn more about everything that I've shown you. I'm going to put the presentation on my YouTube channel so you can review it, watch it there all the time. And then we'll take it on from there. Thank you very much, everyone, for joining.